The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and we're going to be talking about money. You know, one thing that I learned in the last week was about a company in the UK that's selling a new kind of special toilet. It'll analyze what you output, determines what your diet lacks, it will determine what you need to stay healthy, and it will electronically order food from the grocery store and have that food delivered to your house so that your diet becomes healthier. More about that later in the program. More about things like that later in the program. You know, if you have any questions about what you hear on this show, you can tweet us at About Money Radio, and I may answer the question on the air. You can also check my blog, adamsfinancialconcepts.com, and you might find answers there as well. I want to start. We're going to come to the toilet later in the program, so hang on. But I want to start talking about 2016. I've been saying for some time that 2016 was going to be very good for investors, but a very difficult year for investing. And I happened to hear Bob Dahl of Nuveen, their chief strategist, talk. We talked about the first quarter and what happened in the first quarter. We've never seen a first quarter like first quarter 2016. First quarter 2016, the market dropped double digits, then it recovered double digits and ended up essentially flat. I think it's indicative of what's going on in the market in 2016. We're going to see funny things go on all year long. Very funny things. I've got a lot to talk about that during this program today. You know, what was going on, which pulled the market down in the very beginning, were five things. There was a concern that we were going into a recession. And if you listen to the presidential debates on the Republican side, you heard about all the terrible things and how bad the economy was, how the number of job losses, all the things that were going on. It looked terrible. And the earnings outlook looked very, very bad. First quarter earnings have been forecast to be down 9%. They're going to come in better than that. But it was one of the worst earnings quarters since the Great Recession. It's been not a good time for earnings. So there was a lot of gloomy outlook. There was a second reason, is that oil continued to drop and drop and drop and drop. It didn't seem like there was any bottom to the price of oil until we got to zero. You know, the oil prices people predicted would be down to $50, and then they went below $50, and then it got to $40, and then it was predicted that they might get to $30, and it got to $30, and then the prediction was they would go to $20, and it got down to very close, and then it started to rally. It didn't seem like it could find a bottom. And of course, then there was the slowdown in China. China's GDP was slowing down, and China wasn't ordering the same kind of commodities that they had been ordering in 2014 and 2013 and 2012. That was a slowdown. They had dropped commodities purchase like dropping off a cliff. China, a slowdown. People were worried that was going to affect the entire world. And then, of course, there was the Federal Reserve. And the Federal Reserve, some of the thoughts were that the Federal Reserve was going to raise rates 4 or 5 times during 2016. And generally, when the Fed raises interest rates, It means the economy slows down. It means the economy could go into a recession. And all this talk, 4 to 5 rate increases, we've been sitting at 0 for almost a decade, for a good portion of the years from 2008 to 2015, 7 years of the of a 10-year time period. And the Fed suddenly is going to start increasing interest rates. That put people into a tizzy. And fifthly, you had the elections going on with a huge slate of Republican candidates, so many that it took a first debate and second debate on the same night. And those candidates, those were just the presidential elections. You had congressional and Senate elections. All that put into this hopper that put the market down. And then a lot of people don't seem to understand what was really going on in the economy. I've been talking about it now for a good 6 months, that what we've seen is the credit bubble burst. You know, you had all this investment that was going in. You had people putting in trillions of dollars into factories, into oil exploration, into building, drilling, and for wells. You had the gold coming out of the ground. You had all that going into commodities. You had junk bonds. You had a junk bond collapse. You had commodities collapsing. You had emerging markets collapsing. Those emerging markets depending a lot on commodity output. You had private equity. You had hedge funds. You had those things that were related to credit. It all came down. Energy came down. And most people who dealt in one specific area were looking at their own specific area and seeing it come apart. The REITs came apart. All those things, credit related, all those things where there was an overcapacity. I started my career in the aluminum industry. And there's such an excess of capacity of aluminum that the plant I started with in Taco Aluminum up in Ferndale, Washington, that plant is being shut down, or at least all the production facilities to produce aluminum, because it's cheaper to buy it overseas. You have the U.S. steel mills going to the government, trying to get the government to impose tariffs on Chinese steel because they are selling it for close to $100 a ton less than the U.S. is selling their steel. So they're selling it below cost. All that going on. So there was all that concern, and so the market began to collapse. It was beginning to look like it might be tough times in 2008. But then people began to realize things are not quite as bad as they look. For 5 years, we've created more jobs than any other 5-year period of time. More jobs. We continue to create 200,000 or so jobs every single month. Now, actually, when you talk about 200,000 jobs, it's really not that we're creating 200,000 jobs. That's the net. If you look at it over a long-term basis, we're creating 2.5 to 3 million jobs, and we're losing 2 to 2.5 million jobs every month. That's the job creation number. And we've created more jobs than in any other 5-year time period ever. And for all the criticism that was going on saying that it's part-time, it isn't. It hasn't been. 89% of the jobs that are created are full-time jobs, not part-time. You know, and the realization was there wasn't much of a chance of a recession. Unemployment was 5% or a little under 5%. That's not recessionary. And for those people that wanted to quote the number of 60 million or 70 million people out of work, or 90 million people that weren't in the workforce, you know, that included students, that included retirees, that included a lot of people who weren't even looking for a job. People began to realize that was not a real number. You know, unemployment at 5% is not recessionary. Earnings may have been down the first quarter, and the projections are now that they're going to be down about 6%. But that has a lot to do with energy and materials and a few technology companies. It has to do with a strong dollar, but a lot of other industries are doing well. The recovery looked like it was going forward. And oil started to rebound. At the beginning of the year, there was a 2 million barrel per day overproduction. That's beginning to slowly evaporate as economies continue to grow. And yes, there are going to be somewhere in the neighborhood of 175 bankruptcies in 2016, most in Chapter 11, but they're going to keep producing. Private placements are going to be a problem. There's a rumor, when the big producers got together at Doha that they were going to limit production. I don't think that's ever going to happen. It's only a question of who's going to cheat first when they do that. And the question about China, the concern about China. China's not in a recession. Their growth pattern slowed down. Still, they consumed a record amount of oil in the fourth quarter and a record amount in the first quarter. Their exports were growing, and even though they're revamping the economy, they're still growing at a rate that's more than twice what we're growing. And the Fed's not going to increase rates 4 or 5 times. They increased it once, and maybe they'll increase it once again. But they're concerned about global growth, and global growth is going. Don't go away, because I've got more to come back on this subject, and I've got a great guest. So hang on, we've got so much more to cover.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about the first quarter. The first quarter, we have never seen anything like it, with a quarter dropping double digits, climbing back up double digits, and finishing about flat. Never in the history since we've been tracking this have we seen this. And there were 5 reasons, 5 concerns, and all 5 of those concerns disappeared at the end. That's why things recovered. The final thing I didn't talk about was the elections. It's something you get used to. It's just going to be one party saying things are terrible, the other party saying things are great. You have one presidential candidate that a couple weeks ago or a week ago predicted we're headed for a crash. A crash. Anyway, I don't think he's going to get the nomination no matter what. And I think the probability, and you never can be sure that it won't happen, but the probability is very, very low. It's not going to happen. Which reminds me, Bob Veras writes a column, and he wrote a column in the Financial Advisor magazine. And it was how to become a noted, very well recognized financial advisor. And what he had to say was this: pick any old day and call a reporter or a TV channel host or hostess and predict that the stock market's going to hit a disaster. Say it's going to be like something we've never seen before. It's going to be worse than 2008. We'll never recover. Never, ever, ever recover. That was how to become noted. Because you'll get written up in the press. You'll get quoted. And Ferris used examples. Andrew Roberts of the Royal Bank of Scotland in June of 2010, yes, June of 2010, 6 years ago, predicted that we were at the edge of a cliff and we were going to drop over the cliff, and it was just around that the banking system was going to completely collapse. He said, think the unthinkable, because that's what's about to happen. That was 6 years ago. He got a tremendous amount of press over that whole thing. Got a huge following over the whole thing. Or how about Mark Faber? I'm going to a convention in 2 weeks. Mark Faber always speaks at this convention. I've heard him talk about this again and again. But he's known as Dr. Doom. And in 2009, he predicted we were going to have hyperinflation. I was there. I heard it. Hyperinflation. We were going to see inflation at 100% or more, even up to 1,000% a year. The Fed was injecting money, and that was going to be the total result of it. We changed his tune 2 years ago. 2 years ago, he said we're going to have a 1987 type of crash. It's going to drop off a cliff. And again, it's going to happen with no warning. It's just going to happen one day you wake up and the market drops off a cliff, drops a third. That was 2013. It hasn't happened. But he got a lot of press over that. He sold a lot of his newsletters over that. He got a lot of subscribers over that. And I sat in a room at the VIP session with him and with a number of other people who bought into it completely, who signed up for his newsletter, who were paying $200 or $300 or $400 a year for his newsletter because they were waiting for that crash just around the corner. Mike Lombardi of Profit Confidential, writes newsletter, predicted a great crash of 2013. Here we are in 2016. I don't remember a crash in 2013. But that was Vera's prediction. If you want to become really well noted, predict we're going to drop off a cliff. It's going to be worse than 2008, and we're never, ever, ever going to recover. That's the kind of prediction that gets a lot of notoriety. You become an advisor to those who are afraid and want to protect their wealth. And very, very seldom does that reporter or that TV host ever go back and look at how the prediction turned out. That's something that Roberts predicted, that the market was falling off a cliff, never to ever recover. But when he predicted it, the market was at 10,000. Today we're at almost 18,000. But nobody went back to check and say, you were dead wrong. The idea is, if it doesn't work out, to call again and predict it again. Because Roberts, in 2010, predicted we were going to fall off a cliff. No one checked. But in 2012, Roberts came out and said we're headed toward something worse than the Great Depression. Faber said we were going to be down 25%, not up 12%. It didn't bother anybody about their predictions not coming true. They got a tremendous amount of publicity. I predicted at the end of last year that the Standard & Poor's was going to be up 10%, 23.25. We're 9 months away to see if that's right or not. But I just want to take one brief thing and talk about why I think it's even more valid today. Shorting the market is something that goes on. Shorting is when people sell a stock they do not own, expecting to buy it back at a lower price. For example, you sell ABC stock, which you don't own at 40, you're expecting it to go at the 20, and you're going to buy it back at 20, you make a $20 profit. Buying long, on the other hand, is you buy it at 40, hoping it'll go to 60 and make a $20 profit. But shorting is where you sell a stock you don't own. And if you think the market is going to go down, you short stocks. And there's a big difference in risk. If you buy a stock at 40 expecting it to go up and instead there's a disaster and it goes to zero, you lose $40. If you short that same stock and it goes up to 60 or 80 or 100 or $1,000, you don't lose $40. If it goes from 40 to 1,000, you lose $960. It's an infinite amount of risk when you're shorting a stock. Keep that in mind, because right now, so many people are so negative on the market that shorting has reached $1 trillion of short positions. That means there's $1 trillion that people have sold stock expecting the market to go down, and if it doesn't go down, they have to cover that. They don't want their stocks to go from 40 to 1,000. They'll start covering if the stock market really starts to move upward. You have $1 trillion which could come in to buy stocks. You know, people that predict the market are going to go down, people that are looking at shorting the market, that's a positive for me because it means it adds a lot of buyers. I predicted 23.25 by the end of the year. I don't know if my number is going to be close to right, but I do expect that we'll see the market up close to 20,000 on the Dow before the end of the year. One last thought. Bob Dahl mentioned this, that there's two ways to make money this year. One is to look for alpha when there's blood in the streets, to look tactically and buy when things are down, to sell when things are up. Or secondly, to find people who produce alpha, to find people who produce extraordinary returns. When the market's up 15%, finding someone that can produce 17% is not a big deal. When the market is flat, an extra 2% is very significant. That's what we do at Adams Financial Concepts. Okay, enough of me. Let's turn. I've got a great guest who's got a great story. Tom Palladino of Palladino and Associates. Palladino and Associates.
Palladino and Company.
And Company. Sorry about that. Welcome to the program, Tom.
Thank you, Mike. Nice to be here.
So why don't we start with your background?
Well, my background started off in mechanical engineering and aerospace, and I worked on projects like mammography machines, X-ray studies of the sun, and rocket motor inspection systems, all that required buildings, which led me to my second career when I came out here to go to UW for architecture school and get a degree in the Masters of Architecture.
You know, as a child, my perfect profession was to grow up and be a rocket scientist. And you did that.
I did it. I've been there, done that. Yes.
But now you're completely away from rocket science.
Well, I have to say, declaring that this isn't that hard, it's not rocket science, has a lot of weight when you've been a rocket scientist, so it's come in handy. Yes.
That's great.
Yeah.
So let's talk about Palladino and Company.
Sure. So I think the best way to understand what we do is we're coaches for development teams, coaches on real estate development teams. So we help building owners shape and unfold their building projects to create business value by thinking about sustainability, the ability to continue. So it might be looking at how to reduce the cost of energy and water on a building. It could be how does human health and wellness of our employees boost business return. It might be how do we eliminate the cost of environmental impact or eliminate the negative consequences of environmental impact. Putting that all together into an easily understood story for owners is what we do.
And economically, it makes sense as well, right?
It does. And there are a couple of ways that owners look at sustainability, probably a lot like your investor listeners. You can think about sustainability as being an extra cost that I need to justify with a return, or you can say, I have a fixed investment and I would like the sustainability features to be as aggressive as possible within that number. So there's really two camps of how to think about sustainability and cost right now.
So we're going to come back to this question. What is sustainability? so that you can understand what's going on. I think it's something that's really changing, and it is part of the future. We're coming to a commercial break, so don't go away. We've got more to cover there, and we are going to come back to this idea, the question of the toilet. So don't go away. Hang with us. We'll be right back.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Tom Palladino of Palladino and Company. We're talking about sustainability. So why don't you explain or define what sustainability is?
Sure, Mike. So the simplest way to think about sustainability is you're creating a business, a building, a process that has the ability to continue indefinitely without a drain on environmental resources, and usually to some purpose to create some condition of human abundance, whether it's the health of the people or perhaps the business environment they work within. But you're basically trying to harness nature to your advantage without any negative consequences. So your toilet, for example. If you're in an environment where it rains a lot, you could conceivably catch rain on the roof and flush the toilet indefinitely here in Seattle, right? We have enough rain to do that. So that might be a good strategy for Seattle. And so that's a simple concept, right? How do I have nature help me do my job? It's kind of a way to think about it.
So a lot of this we talk about in terms of green building, right? Mm-hmm. So give us some examples of some of the things that you've done.
Well, one way you can make a building greener is use less energy to keep it comfortable. So we've just finished a project in Pittsburgh, Pennsylvania, 33-story tower that has openable windows from the first floor all the way to the top of the building. And it provides cooling for the building 50% of the year. So you don't have to turn on a chiller and make cold water, and you don't have to use kilowatts to make the chiller make the cold water. So it's harnessing free cooling. So that's an example of a building that breathes as a way to think about how do we continue operating the business indefinitely using weather.
And how about light?
Here in the Northwest, daylighting is a common practice where you face the building towards the sky, and then you turn off the electric lights while the sun is up, and you basically reduce your environmental demand for energy because of the way you've shaped the building. And that's done quite frequently here in the Northwest.
So I've heard that if you move the employees by the windows, the productivity goes up. Is that part of the strategy as well?
Yeah, for human health and wellness and productivity, there's some clear research evidence that shows access to daylight, the ability to tune your environment, which in plain English would be open the window or raise or close the blinds, high degrees of fresh air, higher than most buildings would normally provide, and making sure that the air is clean through filtration. If you do all that, the cognitive performance of a knowledge worker goes up significantly, which has productivity impact on the business.
So it's not just an environmental thing. It's actually a cost improvement.
It's a cost improvement. It's a way to think about how do I make my business perform better by having employees that perform better. So in some ways, it's a bottom side up approach. If I invest in a building that makes my employees more productive, happy, and well, my business will prosper.
You know, I belonged to Rotary, and I can remember 25 or 30 years ago, whatever it's been, going and visiting a Rotary Club in Los Angeles. and the invocation, they talked about the day itself, they could look out and see the mountains. It's something that we take for granted today, and in Los Angeles you can take for granted. But the smog was so bad at that time in Los Angeles, you couldn't see the mountains in most days. So I started my career in the aluminum industry, and we had the furnaces which were delivering a lot of pollutants into the atmosphere and adding to smog in this area. And through the laws and the regulations, they hooded the furnaces and deleted most of the pollutants. And I think that was truly a quality of life improvement for the workers there and for the people who lived around there. And what you're talking about seems to be a quality of life issue as well.
I think that's a good analogy. In the U.S. in particular, building codes have set a floor for performance, so you shall not admit X amount of smog. But there are a lot of corporations that depend on knowledge workers to help generate the wealth that they create. So just not having smog isn't good enough for their business. They want to have an environment that produces greater than average performance or greater than average return on human capital, as you might say it here on your show. So if a corporation has the ability to create that better environment and it serves their business purpose, why wouldn't you do it? And that generally is the owner that says, I have a budget for the building and it better make my people more productive within that number. They, I think, are the view of the future in real estate. So that would be my future facing statement.
So normally when you're talking to people, who is it that initiates this kind of thought?
There's almost always a sponsor on the ownership side that has some accountability for sustainable performance in the organization. It might be a sustainability manager or a VP of sustainability. There's even chief sustainability officer now in the C-suite. So they're charged with connecting sustainability in a tangible way to the building portfolio that they own. And so that sponsor usually asks some simple questions like, will building certification help us achieve our business goals? Will going beyond a certification help us achieve our business goals? What does that look like? What's important to us? And then sometimes there are questions around where we're going to build, what's important for the community. So for example, here in Seattle, when I first started my career, there were issues around growth management, so where you put the building was important. And then there were issues around salmon recovery in our urban rivers, and there were issues around spotted owl recovery from timber harvest. So a building back in the 90s focused a lot on water and wood and location and transit. Today it might be a different issue, human productivity.
And it seems to make a difference too with the building codes. You mentioned the building code. Does it move the permitting process through faster?
In some jurisdictions, it does. There are sometimes there's a fast track at the permit counter. Sometimes there's a regulation that the permit inspector doesn't understand very well. So LEED certification, which is a common building certification here in the U.S., could help the permitter understand the right things being done. Some jurisdictions actually have incentives so you can get additional floor area if you go green, and Seattle has a program like that.
So it does help.
It does help if you're paying attention.
So if someone wanted to get a hold of you, how would they do that?
They would go on the web and look up palladinoandco.com, and they would reach out to information at palladinoandco.com.
And what would be the process for them to go through?
Usually there's a first stage where we try and understand what their business objectives are and what they know about sustainability, just to get a sense of their purpose around real estate and sustainability. We do something called a gap analysis, which helps us understand where they're at and where their industry is at and tell them how far they are from first place. And often in most American business, there's some sports analogy that's makes sense. So when you're not in first place, most executive sponsors want to know why you're not and what can we do. And so the next phase would be, here are the steps you can take to get closer to first place.
So again, tell us how they would get a hold of you.
They would go to the web, www.palladinoandco.com, just like that. And there's a contact us page on the website. 206-522-7600 is a phone number that you will find on the website.
Say it again.
206-522-7600.
Thanks, Tom.
Thank you very much.
Fascinating story and really part of the future if you really think about it. This is a direction that we're moving. A lot of people don't really understand, don't see what's happening, but this is a direction, and if you're a business owner, you should be thinking about this very clearly. So I want to shift, and before we get to that toilet, and I will get to that toilet, I want to talk a little bit about financial planning. That's the whole purpose of this segment anyway, is financial planning. And if you've been listening to this program very long, you know that I have a very serious issues with the methodology that we use for financial planning. 2008, 2009 validated those issues. A lot of retirees found out in 2008, 2009 those financial plans didn't work so well. A lot of pre-retirees had to either postpone or reduce their spending plans because they had that financial plan that didn't work. You know, Forbes came out with an article in May of 2012. It's old now, but I think it's still applicable. It talked about Marsha's mom, who was 97 years old. She'd survived a heart attack. She'd survived a broken hip, a bout with cancer. But at 97, her financial plan was at the end. The financial plan was good when it was done. It expected her to have money as long as she lived. But at 97, she ran out of money. Not uncommon in plans. No one expected her to live to 97. Mentally, she was still very sharp, but she needed help with cooking and shopping and taking a bath. But she was out of money. She was down to Social Security and Medicare. That's the sad shape of some of the financial plans that forecast you can have money for almost as long as you live. But they don't really deal with having enough money forever as long as you live. We're coming back. We're coming to a commercial. Don't go away. I want to come back to this whole idea of financial plans.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I owe a lot of the information I'm about to talk about to Joe Coughlin, the founder of MIT Age Lab. A lot of the information comes from him, so I want to give him credit. It's not all of mine. You know, I don't remember the cover, the magazine, but the cover, on the face of the cover said, and I believe it was this last year, there was a child that was born in 2015 that would live to be 142 years of age. Children that are born today are going to live, their life expectancy is to live to be 100 years old. It wasn't that many years ago when Art Linkletter had a program, Queen for a Day, and on that program, being 100 was such an exceptional event that nationally, when someone turned 100 in the nation, he mentioned their name on that program. It didn't happen that often. Today, the fastest growing demographic segment in our population is the 100 plus years old. It's happening today. Yes, and by 2047, there's expected to be more older adults in the world than children. It's an issue which we have to face. It's an issue with the financial plans that we're facing. You know, in Denmark, for example, they're very, very concerned with having more adults than children, or more retired adults than children. Because what happens, if you look at our Social Security system, how does it operate? As we work, we pay into the Social Security system. We're not paying into an account which accumulates the money and then it's going to pay out like a 401k or a pension plan. The money that I am earning today that goes into my Social Security, that comes out of my paycheck, that goes to the government for Social Security, that gets paid out to people who are retired. It's a straight flow through. There's no fund that's accumulating money. It's a flow through. And so as fewer workers there are to support retirees, there's a squeeze that way. Back when Social Security was developed in the 1930s, there were 25 workers for every person that was retired. So you had a lot of money flowing to the retirees. You didn't have a problem. Today it's down and approaching 2 to 1. But by 2047, it's going to be 1 to 1. And in Denmark, it's going to be before then. Denmark did a study, and they found that people had more sex on vacations. More children were born because of those vacations. And Denmark needs more children. So the government has taken out ads to encourage people to take vacations. The ads say, do it for Denmark. Just, that's the issue that's coming up. Too many older adults. So, and we're finding that people are delaying marriage longer. They're delaying new households formed later. And that's having an impact. But people are also living longer. The average age expectancy for someone turning 65 is increasing 3 months every single year. So for year 2016, the average life expectancy of someone turning 65 in 2016 is going to be 3 months longer than the person who turned 65 in 2015, and a year longer than the person who turned 65 in 2012. And that seems to be going forward. So what we're really facing is what's happening once we reach retirement age. And people are beginning to think about that in the financial planning aspect, in the demographic aspect. What do we do? The financial plans that we develop today are based on data that goes back 30 or 40 years ago. We're not current with this in financial planning. We're not taking into consideration. You know, my father died in 1978. I'm sorry. He was 61. But at that time, in 1978, one of the options he had as he was approaching retirement and he was thinking about retiring at 62, one of the options he had was a 5-year annuity. 5 years. Meant the whole thing would be gone in 5 years. And why? Because very often people, once they retired, they died very shortly thereafter. That's not what we're seeing today. And it's not what we're going to see in the next 20 or 30 or 40 years. We have a whole new thing coming. We're going to see a period of time in which there's almost 4 lives in retirement. And it's going to be an issue of managing the ambiguity. It's a matter of having the financial means to get through that period of time. Physical ability is going to be good at 65. You look around and see what the people are doing at 65 and 75 and 80. Physically, most people are in pretty good shape. 40% of the people that have not yet retired are planning to work until they drop. You know, they will be creating some money. They'll be creating a meaning to their life. There's a social aspect. But also, some will be changing professions. Some are going to move into the gig economy. They're going to be consulting. They're going to be making new businesses. They're going to be taking some of the experience they had from the old business, their old position, and converting it to something that they can market. There's going to be entrepreneurs, people that we're already seeing a number of people in their 60s and 70s and 80s starting new businesses. That's happening today. There are going to be a number of people who change their profession, but they need the funds to do that. They need the funds for the education. They need the funds for the training. That's going to happen. Living once you turn 65 could be just a transition to a new job, to a new phase of your work, to a new business. But as you get even older, there's big decisions to make. You know, in 1970, just 17 people lived solo. Just 17% in 1970. In 2010, that had increased to 27%. In Seattle today, 42% of adults live solo. That's changing the work that we're doing. It's changing the stores. Walmart and Target are experimenting with small format stores. I mean, it's not very often that a solo person will go into Costco to buy one avocado. Doesn't happen. People are beginning to change and ask the question, when you retire, what are you going to do with your life? What finances do you need? What finances do you need to get beyond that point? If you turn 97, are you going to have the finances? Are you going to be like Marcia's mother? There are things happening like that toilet from the UK, which are going to give us input into living healthier lives. There's a mirror now. Look into the mirror every morning. It's going to assess your health. We're going to be living longer. We're going to be needing extra funds to get through all that. I don't believe that very many financial plans account for all that. They look back 30 years ago and they plan for what happened 30 years ago. We need smart spending. We need smart solutions. We need knowledge and tools and the emotional needs to get through all this. If you miss any of this, check it out, Adams Financial Concepts, and we'll probably do a blog on this to expand it even more. And until next Friday, when we will again be talking about money.
With Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following